Hey guys, Mitchell with Auction Wolf here. Today we're going to be briefly going over iron condors, continuing our advanced strategy series. This is personally one of my favorite strategies to utilize. It's kind of complex, but once you get the hang of it, it becomes pretty easy. So let's go ahead and come in. Basically, an iron condor is two credit spreads put together. Most people are going to be shorting these iron condors, so it's going to be a credit spread, like a call credit spread and a put credit spread. So essentially you're betting that this stock is gonna stay in between your short range. You're a neutral strategy here. You're not really gonna get too directional with it. When you do these a month out, again, you want to sell it kind of like a 25 delta, perhaps 20 a week out, 7 to 10, something like that. Couple rules of thumb: try to avoid 50-cent strikes and Wednesday expirations just due to the lack of volume and what happens in the market. Additionally, $2 is a good minimum when looking for a net credit there. Our expectation here is that your stock, the underlying stock, is going to expire between your short strikes. So here we have an example. If you'll notice those two in the middle, -1 XYZ July 18 40 call and the 30 put. Basically, we want XYZ to close July 18 in between 30 and 40 to realize our max profit there. So our gain is going to be our premium received. Now, the beautiful thing about iron condors is that you're able to maximize that premium because you only need to hold the margin requirement for one of the spreads for one side, because you can't lose on both. If you realize a max loss, it's going to be the difference between your strikes on the larger side minus the premium, but that's the margin requirement that you're holding as well. So we're able to capitalize on that pair and in a lot of situations double the premium we make. So break even number one is going to be your short put strike minus the premium you received. Break even number two is your short call strike plus the net premium that you received. So some special considerations to take into mind. When hedging, if you see an iron condor position moving against you, you can use a butterfly order to roll the wing up. Because all a butterfly order is a credit spread and a debit spread. So in doing so, you can use that butterfly order with whatever brokerage house you use. If you see it approaching, say, your call side, use a butterfly order, roll it up, mitigate that loss potential. Another thing, try not to double down on these. One thing I've heard before that a lot of people will say, a lot of professionals will say, is losers average losers. Don't be a loser that tries to average down on a losing position that you know is going to lose. So that's just another thing to take away from that. We're going to cover these in depth on our paid content videos and in our weekly and daily trades. So stay tuned for that. And as always, trade safe.